Hey, what's up? John Sonmez here from simpleprogrammer.com. So I got a real interesting question that was posted to me on ReachMe. You can check out the link in the card or in the description below if you want to ask me a question on ReachMe. I don't always do YouTube videos from them, but if I do select your question to do a YouTube video, then you'll get a longer response than that. Then I think the 1 or 2 minute response for the default. You can pay for longer responses as well if you want to keep it anonymous. But in this case, this makes a good YouTube video. So little background here. So this is about employee stock purchase programs, but even if you're not involved in one, you should still probably watch this video because there's some good lessons here in expected value and EV and making decisions about what to do with your money that I think you might find useful. Now, there's not exactly 100% right or wrong answer here. It's very contextual, and it very much depends on your risk tolerance and what you can do with your money. Always, a lot of investment choices are going to determine on what you can do with your money as far as paying off debts, and all of these things are going to be determined by if you didn't spend your money somewhere else, if you didn't put it somewhere else, invest it somewhere else, what is the value of that money to you, right? And that's going to depend on what opportunities and options you have available to you. So let's go through this real quick. This is detailed pretty well here. He says, I've heard you say you should hold ESPP stocks, that's employee stock purchase program stocks, for at least 1 year before you sell them to avoid short-term capital gains tax. My question is why? The general consensus I've gotten while researching this, however, was that you should sell them as soon as you can and put them in some type of index fund. The general idea for this is you already have plenty of risk exposure to that company by virtue of being employed by them. It would be doubly hard hit to lose your job and have its stock value decrease at the same time, the latter of which may make the former more likely to happen. Okay, I agree with that. It's least risky to sell immediately so you can reduce the risk by diversifying. Outside of this, I think mathematically this makes sense as well to sell immediately too. So here's the mathematics behind it. Suppose a stock was at $22 beginning of the purchase period and it went down to 20 at the end of the period 6 months later. Here's what happens. Because the stock went down, my purchase price will be 15% discount to the price at the end of the purchase period, which is $20 times 85% or $17 a share. Okay, suppose I contribute $2.55 per paycheck twice a month. Over a 6-month period, I contributed $2.55 times 12 equals $30.60. Again, don't let the small numbers here necessarily influence you. We want to look at percentages here, okay? So he says, I will receive $30.60 divided by $17 equals 180 shares. If I sell 180 shares at $20 a share and receive $20 times 180 equals $3,600, I will earn a potential profit of $3,600 minus $3,060, which will equal $540. Let's say I wait 18 months for the long-term capital gains. Okay. If everything goes well, I can reduce the tax on your profit, let's say from 35% to 15%. In the above example, that will save me $540 times 20% equals $108, 20% being the difference between the 35% and 15% tax bracket. Okay. But if my employer's stock goes down, and let me take this out because we're not going to actually use these scenarios. I actually copied this from a doc. Okay. But if my employer's stock goes down 3% during 18 months, I was holding the stock, my entire $3,600 is at stake, and the tax benefit will be completely wiped out. Assuming a 3% drop in the stock price, the new stock price will be $20 times 3% equals $19.40. I still have 180 shares, but instead of being worth $3,600, they're worth 19.4 times 180 equals $3,492. I lose $108, and this is the break-even point. Given this, it seems like holding on for another 18 months for some tax benefit and hoping the stock won't go down 3% is really penny wise and pound foolish. I'd love to hear your thoughts on what's laid out here. I would imagine you would have a great perspective on this. Okay. So a couple of things. First, let's address, the big point here, the risk point, without getting into the mathematics and EV. It is true that if you are heavily invested in the company that you're working for and you lose your job, it'll probably, because they do layoffs because they're not doing so well, it'll probably be a double punch in the stomach. However, that shouldn't necessarily be the reason why you make a decision, especially if it's a poor financial decision, which, as you're going to see here, the expected value on making the decision of holding on to it is a little bit higher, or should be higher in most cases. So you're really going to have to, justify this decision to go against that. So what I mean by that is that anytime that you go against a decision that where the odds are suggesting that you do it one way, where you have a higher EV, expected value is essentially what you can expect if you continue to make that decision over time, whether it be positive or negative. So if I constantly make a bet with you that every time that we do a coin flip, which is a 50-50 chance that it will come up heads, and every time that it comes up heads, it costs me $1 to bet with you, I will get $1.05. Okay, every flip has an EV of $1 or has 5 cents. Okay, so every flip that I flip, I may not win every time, but I'm essentially making 5 cents per flip. Or actually, it's half of that. It's because it'd be 2.5 cents. Okay, because half the time I'm going to lose, but when I lose, I only lose $1. When I win $1.05. So half of the time. So I'm making 2.5 cents per flip. Okay, so that's the EV, positive EV, positive expected value. Right. So if you make positive EV decisions, you will benefit in the long run. Now, the contradiction to this, or the place where this isn't true, is where a short-term loss will wreck you. So we could think of a positive EV situation where if I lost, it would be really bad. So let's say that, I'm trying to think, I don't think we could really do this with the coin flip here, but it'd be kind of hard to do with the coin flip. But let's say that I had 1,000-sided die, okay? And actually, we could do this with a coin flip. We could do it with a coin flip. Right? So, no, I'm trying to think. I think the 1,000-sided die will be better. Okay, so let's say we had 1,000-sided die. Okay, forget the mathematics of that. Let's say that what we're going to do was we're going to play this game, and with this 1,000-sided die, okay, if it landed on a 1, I would get $100 million. Okay. But if it landed on any number other than a 1, right? Anything from 2 to 999, right? Or I guess, yeah, basically, right? Or 0. that what would happen is that I would have to pay you, let's say, what would be a good number? Let's say okay. So if it rolls a 1, I get $1 billion. Okay, we'll make this really clear. And if it rolls anything else, I have to pay you $1 million. Okay. Now, mathematically, right? The odds are like from EV situation, right? If you're going to get $1 billion, right, every 1,000 times you roll. So if we did the numbers on this, this is kind of. But you'll see what I'm saying. So if we had, 999 times, we're going to roll this, right? And we're going to have to pay $1 million. Okay. So we're basically going to expect to pay $999 million. Okay. That's a lot of money. Okay. But one time we're going to roll this. Okay. And, I have 1,000 times, and we're going to get $1 billion. Right, which is 1,000 million, right? 100 million, yeah, 1,000 million. Okay, so 1,000 million, which equals 1,000 million, 1 billion. Okay. So if we did this 1,000 times, this is kind of what we would expect. We'd expect to get 1,000 million minus 999 million equals a net result of 1 million. Okay. You'll see why I'm saying this. So this is positive EV. Technically, we should play this game, and we should keep playing this game as much as someone will play this game with us. Even though there's a very low chance that we're ever going to win the $1 billion, and most of the time we're going to lose $1 million, we should play this game because we know, right, where it's like being the casino, it's like being the house. It's going to benefit you in the long. If you do this enough times, it will benefit you. In fact, every time that you do this, right, your expected value on this is essentially $1 million every time you play this game, right? It'd be 1 million times divided by 1,000, right? So if you do this 1,000 times, you expect to make $1 million profit. Now, it's not always going to happen, and that's where it makes sense to go against EV. In this case, you're going to have some pretty deep pockets to keep playing this game. You see, you need 999 million. You need to be able to survive long enough to play this game. So this is where you probably want to say, yeah, you know what? This is definitely a positive EV move, but I'm not going to do this. I'm not going to play this game. I'm not going to bet, $1 million that I'm going to get a 1 out of a 1 in 1,000 chance. Okay. Even though you're going to pay me $1 billion, even if someone paid you more, 2 billion or even 10 billion. Okay. So it's really high expected value. It still doesn't matter, because if you lose one time, which you're going to have a 99.9% chance of losing when you play one time, you're out of the game because you don't have any more money to play anymore. Bad. Okay. It's bad. So this is where insurance, this is why I did this video on insurance. You can check it out here. You go click the card and click below. I guess this is going to be a long video, but this is where having insurance makes sense, or buying a warranty, right? Normally it's a bad move because you're betting against the house, but insurance makes sense when a catastrophic loss will wipe you out. So this is where it makes sense to go against EV. Otherwise, it doesn't make sense to go against EV. Okay. So what is the case here? Do we have a positive EV or a negative EV situation? Now, one of the problems that we have is that we don't know what's going to happen, right, statistically in the stock market, right, or with these stocks. But I can tell you this. Here's the thing that we need to look at, that we need to evaluate here. Okay. So what we're getting here is essentially a guaranteed 3% return on our investment. A guaranteed 3% return on our investment, okay, with potentially more. But whatever we get, we're getting an automatic 3%, okay? So if you turn down this, if you sell your stock immediately and don't take the capital and pay the full 35% instead of the 15%, you're essentially giving up 3%. So whatever you do with that money in that 18 months, you have to be able to say, John, I can do better than 3% return on that money, pretty much guaranteed, or with a very high probability, because you'd be turning down a guaranteed 3% return on that money. Now, what do I mean by this? I'm going to try and make this not too complicated here, but there's two ways to look at this, okay? The simple way is to say this, okay? You're getting $540 profit that you're going to have to pay taxes on. You're saving 20% on that money. So this $540, okay? Are you getting a 20% guaranteed? You're getting it on the 540, but you have to risk the whole 3,600. So if we look at this, we could run the numbers and we could say, well, you're saving $108, okay, in taxes. $108 is 3% of $3,600, okay? So that's one way of looking at it. Another way to look at that is that you're saving 20% on 15% of your money, because that's the profit that you got here with this 15% discount, okay? So again, that still works out to the same, which is 3%. So it's a guaranteed 3% return. So again, you could look at this and you could say, okay, if the stock goes down 3%, yeah, you break even. But breaking even is pretty damn good, okay? Now we're going to ignore the taxes. You're still going to pay taxes on the profit that you make here at the 15% margin. But essentially, like you can probably have the stock go down at least 2% or 2.5% and still break even, right? So that's pretty good. That's a pretty decent EV, right? We'd say in most scenarios, unless you've got something better that you can do with your money. This is why the EV is not guaranteed. It's not variable. We don't know what's going to happen with the stock, but we can't predict that, so we can eliminate that from the equation. But what we can't eliminate from the equation is what could we do with that money. So if you have somewhere to invest $540 and that you're going to make a higher than 3% return in 18 months, then you probably should do that and sell the stock immediately. But for most people, that's not the case. Again, and I'm talking about a guaranteed return, right? And this is an after-tax return because you've already paid the taxes. We're talking about saving taxes. So a post-tax return on something, right? So most people are in the 20 to 30% tax brackets for a federal tax level. So whatever profits you make, if you make a 5% return on something that you've invested, if you take out the taxes out of that, it's probably going to be back down to 4 or 3%, right? So in this case, we're looking at an after-tax return. Is this big numbers? Does this matter that much? Not really, but should you give up a 3% edge when you have a 3% edge and you don't have something else better to do with it? In most cases, I would say probably not, right? It just doesn't make sense to give up a 3% edge in a lot of cases unless you've got something better. Now, here's the contradiction here. When I quit my regular job, okay, I took out all my 401k money, okay, and I paid not only the taxes on it, but I paid a 10% penalty. And my accountant was like, "What are you doing? You're crazy. This is stupid." But I said, "Well, you know what? I can beat that. I can beat the 10% return. I can make more money on this, even taking that money out by investing in real estate, because I know that my real estate investments return a higher return." Again, you can check out, I did a video on the ROI of real estate, which you can check out here, that explains how that works. I'm getting a higher than 20% return on real estate investments. So that's what it comes down to, is right. So if you're just going to plan on taking the money and putting it into the index fund, okay, it's a marginal decision, but you're immediately going to have to take whatever you make from that and take 3% off of it. Right. Because you see what I'm saying? So let's say you took that money, this $3,600, okay, and you went ahead and you paid the taxes on the 540 there. So you basically paid taxes $180. So you're left with, what are you left with? You had 3,600 minus $180. You're left with your $3,420, and you put that into the stock market, an index fund. You have to pay some transaction costs, I think, to do that. But that aside, okay, if you get a return from the stock market in that 18-month period, you're basically going to have to, say, well, I could have made $108 more, right? So you're almost going to have to discount that return by 3%, is essentially what it's going to come down to. So you'll be turning down an advantage in that case, right? Because you could have saved yourself that money. Now, the other thing is, like, again, we're looking at worst case scenario here. Okay, this could go up. It could go up 3%, but we can eliminate that. We don't care whether it goes up or down. We only care about, because we can't control that, we can't predict that. We only care about whether what was our guaranteed return. So in our case, our guaranteed return was a 3%. So we had an EV that said this. So now, if there's a higher EV move, right? So this is the other thing, is this is what we're talking about here. Sometimes it's between an EV, positive EV, and a negative EV. It's pretty obvious what you should do in that case. But the question is there a higher EV move? Is there something else that will give you a higher expected value? And that's what it came down to, is what I'm saying here, is that if you can make more than 3%, with a high probability of success, okay, and then you should do that, because it's a higher EV move. But for many people, the highest EV move is just going to be to take the 3%. Okay, it doesn't matter whether the stock goes up or down, because that's, you're putting some risk out there, right? So if you're risk adverse, right, if you can't afford to take the hit on money that you've already made a profit on, which shouldn't be the case, right? Then okay. But if we were to compare it, if we were to say, what was your if you're just going to take the money and you're just going to put it in an index fund, okay, it doesn't make sense. It really doesn't make sense, because you'll be giving up 3%. You see what I'm saying? That can't be a higher EV move than leaving it in the stock, right? Assuming that you have, just as much chance as the index fund doing well as the stock, okay, which we can't predict the future. So you kind of have to make at least, so it depends on how volatile the stock is. I suppose that could matter as well. But in general, we could count those as the same. So in one scenario, in the scenario where you sold immediately, right, you'd be taking a 3% hit, okay, and then you have the money in the index fund, so you're losing that $180. In scenario 2, where you held it for the 18 months, you're going to save yourself $180. You're going to save yourself 3% on that, instead of being taxed on that. So it's going to have a higher EV in general, assuming that, if you had some knowledge, which you can't have knowledge, that the index fund would perform better than the stock, then sure, but you don't have that knowledge, so it doesn't make sense to assume that. So in the long run, the highest EV move would be to continually do this, right? If you're choosing between those two choices, okay? So you would continually, every time you'd have a system and you'd say, I always hold on to it for 18 months and then I sell it. And then that would guarantee you that you're actually making an additional 3% always, right, on that money. So that's a positive EV type of move. Now, that again, it doesn't mean that it can't go down, okay? The stock could go down and you could lose money, and you could say, and here's the thing, this is how a lot of people would play this. I know this is a long video, but this is important to understand. But a lot of people might play like this. They might say, okay, that makes sense. I'm going to hold on to it for 18 months. So they hold on to their stock for 18 months and the stock drops. It drops 25%. Okay. And they're like, shit, that was a stupid move. That's obviously not the right move. I shouldn't have done that. I'm never doing that again in the future because I got burned on this. And that's wrong. That's the wrong conclusion, right? You do what's mathematically correct, right? Whether you get bad luck or not. Okay. In the case of, we did this little roll thing here. If you have, let's say $5 billion worth of bankroll, okay, you should play this game a lot. You should play this dice game. Okay. It doesn't matter that you're like, man, I lose almost all the time. I mean, maybe you need more than 5, but I don't know how deep you need to be. Probably if you had $100 billion, you should play this game all day long because you're generating money by playing this. Every time that you roll that die, you're making money. Okay. It might not seem like it. You might be like, man, I rolled this thing 2,000 times and I lost every time. Now I've lost $2 billion. What the fuck, John? It doesn't matter. Keep playing the game. Because this is if you live your life this way, right? Again, if you're going to get wiped out, that's a totally different story. But if you live your life making positive EV decisions, you're going to win. You're going to benefit more, right? Most people can't afford to pass up a 3% edge, a 3% gain on their money, right? Most people can't. Okay. Now, I'm not saying that everyone can't, but most people can't. And if you and see, it's not just about this one decision. This is the thing, is right? You might say, well, it's only $180. I don't care. I'd rather not take the risk. Wrong. I'll tell you why. It's because you're going to live your life this way. You're going to make every decision this way, and that's going to add up. If you're making decisions, if you make 50 of these kind of decisions a year, okay, where you're giving up small edges, 3% edges, okay, over 20 years, over 30 years of your life, it's going to be huge. It's going to be the difference between being homeless and being a multimillionaire. Honestly, in the long run, you're giving up too much, right? In the long run. And that's the thing, is we got to think about the long game here. So I know this is a long video to discuss this topic, but and again, the numbers don't matter as much here. I just want you to understand this concept of EV, and that you can't pass up positive EV situations, right? And you should always pick the higher EV situation. The only exception to that is when the risk, right? When we played this dice game, when it can wipe you out. If you have $1 million, don't play this dice game, okay? It's not going to make sense because you're going to have a 99.9% chance of being wiped out completely and not be able to play anymore and lose $1 million, okay? If you have $100 billion, play this game all day long. If you're somewhere in the middle, that's where things get dicey. You might have to decide, like, probability wise, how much risk can you put out there, but anytime that you have enough money. This is why, again, with investing, with a lot of people asking about stock trading and poker playing, it's all about bankroll management. It's all about surviving the ups and downs, right? So that you can continue to make positive situations. If you don't have enough bankroll, if you don't have enough depth, you can't make decisions like this dice roll one, right? Where it is clearly a positive. And there's a lot of advantages, a lot of things in life that will be only available to people who have a high enough risk tolerance, okay? And what that means is that they have to have enough bullets in the chambers, enough bullets in the gun to be able to survive long enough to see the EV work itself out percentage wise. Okay. So you got to have enough shots to take, right? Venture capitalists, right? Startup investors, more VCs do this. Okay. It's not that they're just lucky or they're good at picking companies. It's that they have enough bullets in the gun. They've invested in enough companies that they know that's a positive EV move, right? That in order to do this, even though 90% of their picks are wrong and they lose all their money. Okay. But but they make a lot of money. They make the most money. Why? Because they constantly make the positive EV choice. And so this might not seem like a big deal, but it really is a big deal because you have to make positive EV choices in your life. Most people cannot afford to give up a 3% edge. All right, that's all I got for you today. If you haven't subscribed already, click that subscribe button below. Click the bell so you don't miss any videos. I'll talk to you next time. Take care.